Hello friends, welcome back. Last week I couldn't able to post a video. I couldn't able to get time. So sorry for the delay. So this week let's get into this one. Today I'm going to give you an idea about how everybody looks at the market and how they feel greedy about getting rich earlier. Right? I'm going to break that myth and I'm going to give you a practical tip and practical knowledge on how to build your real wealth. So let's get into detail. This is Sundar and you're watching Mindful Finance. So today the topic is illusions of overnight riches. Right? So everybody feels that if you get in the market and you will become rich very fast, and the growth in the market is so high than any other asset class. So everybody come and try to put their money in stock market. Right? So let's get into the details. And if I see open about any kind of a YouTube, my feeds normally shows up saying that like the YouTube thumbnails are like from 3,000 to 3 crore, 5,000 to 5 crore, right? It sounds magical. No, so you just miss one day a cup of tea, and within a week or month you will become rich, and you can buy a private land, right? So save every money to become rich. But wealth doesn't come in shortcuts. It comes with a process, with a discipline, and yes, even with boring habits. Let me show you how. Investing is not gambling. It's actually like a civic duty. When you invest in good companies, you fund their growth. They hire people, they expand, economy grows, and you also share the profits. But then most people don't treat it like this. They treat it like a lottery. One friend says hidden gem, another relative says sure short tip, news channels will shout by now, and you chase without knowing why. That's how people lose confidence. So let's put some structure to this one. Two words decide your result: what and when. What is equal to what you buy. You need to check the fundamentals. And when you buy and when you sell, you need to check the timing. So technical comes into the picture. But then here is why timing is underrated. Infosys was a brilliant company during 2000.com boom. But if you bought at a peak price, you would have waited nearly 10 years to recover. So wrong timing, wrong result. Now take airlines in 2020 during the lockdown time. So now take airlines in 2020 lockdown. Fundamentally weak businesses. But because timing was right, many doubled in weeks. Right timing gave money even with average companies. So yes, good company is important, but enter at the wrong time, you suffer. So right timing will improve your odds. So don't open your app and just search random stocks. That's like entering a supermarket blindfolded and filling your basket. But then smarter ways to start with industry. Which sector have tailwinds? EVs, pharma, specialty chemicals, digital payments, renewables. Pick the industry first. Then pick leaders in that industry and ignore the WhatsApp university. If someone says hidden gem, it usually means someone else is exiting. So here's a quick filter I have created. Okay, if one switch is off, keep the stock. So all this has to match. Sales must grow steadily, like your salaries would go up over years. Gross profit must rise with sales. If sales are up but profit is flat, it means the company is only giving discounts. Net profit should grow faster than sales. That's efficiency. EPS should be above industry average. That's like your income per person in a household. So higher means better. And PE should be at a below industry average. That's like not overpaying for biryani just because the restaurant is famous. But then good company is not equal to good price. Always check both. The next point is spot the trend. Charts normally scare the beginner, but let's simplify it. It's very simple to look at. Uptrend. New bottoms are higher, new tops are higher. Twice in a row. Then it's a green signal for it. Similarly, downtrend, new bottoms are lower, new tops are lower. Twice in a row, clear exit signal. But then don't try to be a hero catching a lowest or highest price that when the prices are higher and price also lower like that cinema. Real wealth is catching the middle ride. Buy when the trend is clear. Exit before it reverses. Don't try to catch the falling knife. People used to say, right? Don't do that. And don't try to buy at peak level. Now comes a great differentiation you need to find out. Who are investors and who are speculators? Why does market swing so much? Because investors and speculators play differently. Investors use their own money, they buy shares, take delivery, and can wait for years. But the speculators use borrowed money, futures, margins, options. This expire in days or weeks. So that means they must close the trade. If they buy today, they are forced to sell tomorrow, whether profit or loss. So, but then the forced buying and selling creates sudden spikes and drops. The real direction always comes from investors who hold long term. Now, the classic mistake. Okay, say for example, at 20, nobody buys. Why? Because it looks too risky. Our brain says if it is cheap, something is wrong. At 90, suddenly everyone buys. Why? Because the herd mentality. If it is going up, I'll miss out. Then again it falls to 50. Panic at 20 again, they'll sell with loss. But then the market is not wrong. Our emotions are. It's greed at 90, fear at 20. That's a psychology trap. A simple stock plan. Okay, I hear from this. These are the ideas I hear from the experts. Multiple experts. I listen. Like I have read multiple books, uh, technical books like Pring's, right? Technical analysis explained. So those are the books clearly explain this one. For example, you buy a stock at 1,000 SAS at say 100 rupees. Fix a stop loss at 90. No emotions. At 120, let's sell 100 stocks. At 140, sell another 100 stocks. And you have to trial your stop loss upwards so as stock price goes up. This way, winners pay you while they run. Because you won't feel that if you exit earlier, you sell everything, and if the market goes further up, you will feel a pain. You will feel pain, right? But if this feels like too, it may feel you may if you are feeling this is a too much of effort. That's okay. Don't worry about this kind of a thing and just simply do SIP. You are not right for this particular thing. Just invest in index fund. Let stocks do the business. You don't need to worry about that one. You don't take risk, right? Why you need to care about that? So now comes the decision. It's a very important thing like SIP versus stocks. The SIP is like brushing your teeth. It might be boring, but keeps you healthy. Stock picking is like a new diet. Day one, it will be like more adrenaline, it's motivating, but day three, you start to eat biryani. So keep it simpler. Like you can have your core portfolio as Nifty 50 or Nifty 500, do as a SIP and add a flexi cap or hybrid fund for a little bit of some adrenaline, right? And keep from 5 to 10% in gold ETF for hedge. But don't get into the jewelry because the GST and everything will eat your profit. So don't do that. Once everybody listens to this thing and everybody's understand, and when they start the SIP, when the direction changes to SIP now, people immediately start to use the SIP calculator and says 10 crore in 20 years, but then you will give a fine print, invest 2 lakhs per month. Right, 1 month. Salary itself is 50,000. Where do I get 2 lakh? These numbers don't motivate. They actually discourage you. It makes you think this is impossible for me, right? But the real goal is not chasing your 10 crores. The goal is discipline. Start with 2,000 or 5,000. That's like skipping one pizza night or 2 movie tickets. So just build the habit. Increase when income grows. But then once saving becomes automatic, wealth follows naturally. First discipline, then your dreams. Data plus framing. This is an important psychological thing. If I say 80% chance of loss in short term and you'll run. But then if I say 20% chance of profit, you'll feel cautious. Sorry, you'll feel curious. Same math but a different framing. So that's why I don't use data to predict next month. People may show using the data, the past data, see this is how the thing. You invest this one, see every year you see this is the growth. So that's why I don't use data to predict next month. I use data to set rules. Short term is noise. Long term is steady SIPs. Odds improve a lot. The next one, important point in our life, debt kills compounding. Please, if you have debt, close your debt. For example, your SIP makes 12%, but then your credit card charges may 36%. Who wins? Definitely not you, right? So keep your EMIs within 40% of your salary. If stuck, pay minimum on all loans, clear the smallest first, then attack high interest ones like snowball method or avalanche method. If you earn 50k, don't keep 30k in EMIs, you'll suffocate. Pride won't pay bills here, but a plan will. The next important point is protect the downside. You might be doing disciplined way, but one hospital bill should completely wipe your 10 years of savings. So don't get into that. So the basics first. Term insurance, family health cover, at least 6 months of emergency fund. For example, if any case, if your salary stops tomorrow, you should survive at least 6 months, assuming that in 6 months you may get some job. But then most people skip this and they chase hot stocks. Always reverse it. First protect, then grow. So these are my clean rules, my simple rules. Spend less than you earn. Invest the gap every month. Review yearly, not daily. Don't marry the stocks. Marry the process. Don't chase buses. Obviously, you'll get another bus. Why you think you will miss the bus? Don't avoid the FOMO. So 3,000 to 3 crore overnight. Sure, if overnight means 20 years. But then, if you build habits, follow process, and stay disciplined, you don't need any shortcuts. Top 1% results are luck. Top 10% results are system. And I'm a system guy. So if you like this one, just share this with your friend who only reads thumbnails, comment, thing like 3,000 to 3 crore. Just comment your plan. What industry you like and one filter you'll use. And what is the SIP amount you're planning. So be disciplined. That's what I just want to say. If you like this video, don't forget to give a simple thanks at least. Thank you.